Hi, Else here, and in this video we'll be solving problems using the financial reporting elements and the accounting equation. Note that the problems we're going to be solving are available for download. Want to do well on your tests and extend your learning? Try and solve the problems first before I go through them. Research shows that students who attempt a question and fail are more likely to learn than students who just follow along when the instructor solves the problem. Do what's best for your learning. Download the problems and try them yourself first. Let's quickly remind ourselves about the interconnection between the elements and how they make up the accounting equation. I always use the diagram, but you can use the formulas. Either one will work just as well. Note that the basic accounting equation is assets equals liabilities plus equity. So we've got the basic accounting equation right here. But equity is expanded. So equity is made up of owner's capital plus retained earnings. Retained earnings is the profit that's retained in the business for future development and growth. What makes up retained earnings? Retained earnings is profit minus the dividends. Dividends, of course, are distributions to the owners. What makes up profit? Revenue that is earned minus the expenses that are used, consumed, or incurred in order to help generate revenue. So you can see the connection between all the elements and sub-elements. Let's start our first question. I always recommend to students that they read the question first without underlining or changing anything, and then read the question again. This is always a good policy so you clearly understand the question before you start developing your answers. If expenses increase by $7,000, what happens to equity? Try it again. If expenses, anything that is used, consumed, or incurred to help generate revenue, increase by $7,000. So my expenses are going up. What happens to equity? So expenses have increased by $7,000. Expenses have a negative in front of them. The negative indicates what's going to happen to equity. So if expenses increase by $7,000 with a negative in front of it, equity is going to go down by $7,000. Similarly, if dividends increase, dividends have a negative sign in front of them. An increase to dividends will also result in a decrease to equity. Perfect. Let's go on to something more difficult. Question 2. The owners of a business contribute $50,000 each to a business. During the year, the business has costs of $89,560, paid dividends of $10,000, and earned revenues of $114,230. What is equity at the end of the year? This is a fill-in-the-blank question. So read the question again, fill in whatever you know. The owners of a business contribute $50,000 each. The each is very important. $50,000 contribution by owners is owner's capital. So we have $50,000 times 2, which is equal to $100,000 increase in owner's capital. Perfect. During the year, the business has costs. Costs are the same as expenses, used, consumed, or incurred to help generate revenue. $89,560. Notice there's a negative in front of it. Keep in mind the impact on equity because of that negative. Paid dividends of $10,000. Negative in front of that. And earned revenues. We know revenues have to be earned by providing a service or delivering a good. $114,230. So now it's just a matter of solving. Move up from the bottom, go to the top. So revenue minus expenses is equal to $24,670. Profit minus dividends is equal to retained earnings. So retained earnings is equal to $14,670. Now I want equity. Equity is equal to owner's capital plus retained earnings. So equity is equal to $114,670. What is equity at the end of the year? Our answer is sitting right there. See you in the next video.